Folks, we need to talk about Goldman Sachs. Goldman Sachs is a Wall Street firm that is the best of the best. And recently they pulled an entire 180 on the housing market. We have the one and only Lance Lambert from Fortune, who is housing, and he has his the pulse of the market. So Goldman Sachs just changed their opinion, right, Lance? What's going on? What happened?
Yeah, that's right. Let me pull it up and I could share my screen and show the readers. Um,
Let
if
me just
there
give
we go.
you, I just gave you access.
Okay. Okay, I'll
Perfect.
pull it up now.
Okay, I got it.
Okay, here we are. So this is what Goldman put out on January 10th, which right
Okay.
now is January 26th. So this is 16 days ago.
Okay.
They downgraded their housing outlook and they went for a drop of 6.1 for 2023, which
Okay.
essentially took us to like around a 10% peak to trough.
Right.
Because remember, in 2022, we were up 10%, and then
Mhm.
Goldman has us up 7.5. So we rolled over some in the final 6 months of the year. So they had us dropping 6.1 for 2023, which historically 6.1 is actually a pretty sizable drop for one
Yeah,
year.
I mean it's in the top quartile for sure.
Yeah. And then 10-year, they still had the 10-year yield over 4,
Interesting. 4.2.
that's actually higher than we are now.
Oh
And they
yeah.
have mortgage rate 6.5, which that's higher than we are now too.
Hmm.
And so I would describe that as a bearish housing forecast for the year, one that would be fairly painful for those who worked in the
Hmm.
industry.
Sure.
Not be, transactions would be very low, and there would be some rollover going there as,
Well,
affordability.
let's just say that if this call was right, and again they pulled a 180, so we'll talk about that in a minute. A 6% national decline is on the higher end of what's historically happened. And just to put that in context, we would have millions of homeowners underwater. If you had a VA loan, if you had an FHA loan, 3.5% down, a negative 6% drop in median home price. Again, these are all medians and averages and all of that, but you could be upside down 10% with selling costs. So that would be household wealth destruction
Yeah.
if that
Well,
happened. So
the good thing would be, though, if we drop 10% peak to trough, which that's what that 6.1 is, that
mhm.
would still only take us back to October 2022. So
Right.
it's
So yes, yes.
prices went up so fast that them dropping is just something the Fed's not afraid of in
Mhm.
terms of underwater.
Agreed.
But some people have already been put underwater, new
Mhm.
buyers at the very peak out west. But
Yep.
yeah, 10% would get some more, not as much as 10% would have done the last cycle. So
Correct.
then um, on Monday, they came out with a revised forecast.
So
And
did I catch those? Sorry, Lance. Did I catch that right? This was 2 weeks, like the 10th to the 24th.
yes, this is
Okay.
essentially, and by the time it was all reported, they must have already been working on this update. So
Got it.
something almost immediately happened. And I'll give you some of my theories on it, but let's look through the data first.
Sure.
So now you can see they have upgraded their 2023 forecast for Case-Shiller, which is what they
Mhm.
were forecasting on the other one, to
Okay.
2.6. So from 6.1-ish to 2.6. That's like almost a 4-point swing. That's very rare in a 10-day span.
Yeah. You think that's a 50% improvement?
Yeah, well, it's essentially saving an entire year of historical appreciation because the
Correct.
market usually goes up around like 4.6, 4.7 a year.
Mhm.
So pretty big swing. And I will say one thing that is a little notable here is if you come over to this side, you'll see that the other forecast had us up 7.5 for 2022, and this has us
Mhm.
up 7.1. So they've
Okay.
actually added a 0.4 shaving off of 2022. But we
And
won't,
again, this is Case Shiller's end of year number, which we haven't
yeah.
seen yet.
So
We won't see December till February.
yeah, in November,
Okay.
November and December, yeah, is what we're waiting on.
Okay.
And so they
Just
think
making
they're a
sure I
little
know.
worse than they expected, but then they think this year isn't going to be as bad. And
Hmm.
so if this is right, what they said is that We expect peak to trough decline in national home prices of roughly 6%, and for prices to stop falling, declining mid-year 2023. So it's essentially saying that 4 percentage points were from last year and 2 from this year. So we'd be 66% of the way through the national home price correction.
Yeah, I actually want to look at these other lines because I think these are this really tells me where Goldman's economic view is, right? We look at unemployment. Yeah, you've nailed it, right? They think we get to a peak unemployment in 2023 of 4%.
Yep, 4.2, and then already starting to go down.
Yeah.
And then here's the part that raises some eyebrows, which is they still have the 10-year at 4 through the year.
Wow.
So what are we, 3.6 right now?
Well, last time I checked, 3.5, 3.52.
So
I'll check
we'd
right now.
have to go up. And do they have mortgage rates here? No, but based on the last one that had 10-year at 4.2, we can guess they're probably thinking like 6.2. So they've come down a hair on mortgage rates. I'm assuming, given that actually, no, I'm looking at this wrong. They're still at 4.2 for this year for 10 years.
Yeah, they're high. Yeah.
So, and that carrying into 2025. So so that's also something interesting, is they're saying that even if the bond market even goes up a little from here and stays there for the next 3 years, they still think 6% peak to trough drop, with it fizzling out mid-year 2023.
Yeah. And then the other thing I look at is the inflation number, right? Again, consumer CPI, that's got to be headline, I would guess. Yeah, that's headline 6.4. Then you have core CPI at 3 with core PC, which again, we get on Friday for the latest reading is interesting. So they see headline coming down faster than core, which is interesting given that oil and gas is actually up. So it basically, I guess I would say Goldman sees a soft landing if I were to kind of internalize this at the macro.
Soft landing. Yeah, that is actually, if I had to describe this, I would say this is perfect, is what the Fed would probably see this as.
The Fed would say, I'll take that. If you offered this to the Fed in June of 2023, they would say, sign me up.
And and the two numbers that might be the most important to the Fed, if this were all to happen, which this is not going to happen because forecasts just never.
Yeah, they're never right. Yeah.
They never land like that. Is see here appreciation. Those are very low numbers, and so it's not like the pandemic housing boom comes back to life. That would be, probably the bigger fear. And if you read through the Fed research over the past 12 months, they have been watching housing very closely, and they see it as one of the major drivers for inflation. So I think they would have some peace of mind here that it wouldn't roar back. In a 6% peak to trough drop, that's essentially just taking us back to the start of 2022. Yeah. It essentially wipes out the appreciation of 2022. Fairly gets close to it, but the
last thing I look at on this chart is that existing home units, right? We did just over 5 million in 2022. We got a reading for December at 4.02, I believe it was. And I've told people we're at the trough of transactions, and it looks like Goldman agrees with me. It's kind of, that's the trough. We're going to just bump along the bottom all year.
Yeah, and let me go back to the other one. The other one's not as complete with all the numbers. Do they have? No, they don't have that number there for existing. But I think essentially what's happened is that now that mortgage purchase applications, which is a great leading indicator, now that they've bounced off the bottom, and they've came up at the start of the year, I think that there's a belief that we could be hitting the demand trough.
I agree.
So that obviously there's a difference between a demand trough and a price trough. They could coincide, they could, and but most of these Wall Street firms think that the demand trough comes first and then the price trough comes later. But why the demand trough is significant is that the depth of the drop in transactions, in their view, impacts the depth of the drop on the price side. So if the housing trough comes earlier, their view in their models is the price drop isn't going to be as deep. And a
Right,
big reason
yeah,
that
that
the
makes
price
sense.
drops even got pushed lower was because the last 3 months of the year, especially when mortgage rates hit 7, transactions just really started to move down.
Yeah.
And so the drop in transactions in the final 3 months of the year was more significant than they thought it would be, at
Yeah.
least in August and September.
Yeah, the wonderful thing, and again, folks need to follow you on Twitter. Your handle is at News Lambert. You see it right there in the upper right hand corner. Because you put out daily stuff that's amazing. I look at it every day now. It's a habit of mine in the evenings. So thank you for that. But the interesting thing for me as somebody who has 12 crazy housing calls is one of them was the experts are going to go the other way. I think they got too negative. I think they allowed their models to incorrectly assume the worst of the worst would continue. And Goldman Sachs is the first to come out and say, maybe we got a little bit too negative. And as everybody knows, one of my 12 calls is the most negative, at least in my opinion, was John Burns at negative 22. I believe they will change their opinion by May.
Well, so I would say KPMG is probably the most negative,
Oh, okay. I did not
because
see that one.
the John Burns one could include new homes. I forget what theirs includes, and so if there's new homes, that's a very different story.
Fair. That's fair.
But KPMG was 20% in a year,
That's
and
never happened before.
no,
Not on a national level. It's never happened before.
yeah,
So
things would need to materially change because those
look at
the,
you being coy with your words. They would
uh,
have to
the
materially change. You think?
the 4K shillers that we had last year that were drops, which was the first time since 2012 we got a negative
Yeah.
K shiller reading, and then we got 4 in a row. It was 2.4% drop in 4 months, which annualized is 7.6% decline. So if it continued for 12 months, that would be 7.6, which means that we would need to,
Almost triple.
yeah, the
Yeah.
pace. Yeah.
So KPMG is just wrong. They got too negative. I look at John Burns because John Burns is somebody I have followed for a long time. I've been lucky enough to interview Rick Police a couple of different times. I love that organization. I just happen to disagree with this one call, respectfully disagree. And I thought it was so important to put it out there early that it's one of my 12 calls that they will change their opinion to 10% by May. We'll see what happens. I'm just going to keep putting it out there. Maybe I'll get lucky. Lance, you do amazing stuff. Where should people follow you, and how do they find all your great fortune articles?
Yeah, so you can Google me, Lance Lambert or Lance Lambert Fortune in Google, and you'll find all my stories. And if you want to find my Twitter handle, it's just at News Lambert, and I try to post everything there. Any forecasts that drop, bullish, bearish, you'll see it there if I find it. And if you see one that I haven't shared, send it to me and I'll share it.
Yeah, I'm addicted to your page or whatever we call it these days. Every night I'm looking at it. So keep it up. Thanks, Lance.